Hi, everyone. It's Theodora, and I'm here with Professor V.G. Narayanan to talk about personal finance. He is a world-renowned economist and professor at Harvard Business School. His research focuses on management accounting, and he is the author of 2 books and numerous articles and cases on the subject. Over the past years, he's also taught a short intensive program at Harvard Business School on the subject and has helped many, many students think about financial planning as they start their careers. Professor Narayanan, thank you so much for being here today. I really appreciate it. So as a musician, you know there are 2 things. One, you have a very irregular income, and 2, no one tells you how to deal with your financial planning. And I know that I'm very lucky because I'm surrounded by people who can help me with that, but it is not something that I was taught in my formal education, and it's really important. So I want to start off by talking about retirement because it's something that we all need to plan for, but we don't necessarily know what to start off with. Maybe you could give us some insight and tell us, for example, when do you start? How much do you save? That sort of thing.
I think the key to successful retirement planning is to start early. The best gift you can give yourself is the gift of time, because the power of compounding of money. I've seen studies where people say you just save for the first 10 years of your career and then stop saving, versus you start after 10 years. It's like people who start late can almost never catch up unless they invest like significantly larger amounts of money. So the best gift someone can give themselves is to start early. And it always feels like, I'll earn more. When I earn more, I will start saving then. Now I'm not earning much. But I think if you start early and try to budget your expenses and are very thoughtful about how much and more deliberate about how much you put away for your saving, etc., that's a habit that will last a lifetime. And so even without the power of compounding and all the other benefits I talked about, just the habit formation of starting early and being deliberate about it and being thoughtful about is extremely important. So the answer to your question is it's never too early. I tell teenagers they should be saving, they should start, it doesn't matter how much, but start young, start early. And for some people, it's the fact that when they're younger, they don't have as many commitments. They may not have a family. They're not taking care of their parents or kids or things like that. They have fewer commitments. And that's also another reason that they're able to save when they are younger. So starting early is important. The second question I think you asked me is how much. And a lot of financial planners say that if you saved regularly 15% of your pre-tax income, you'd be in good shape by the time you're in retirement. Personally, I think that 15% is probably the lower bound. If you can do better than 15%, push closer to 20%, it's even better. Because there are a lot of demographic changes that are happening in our society. We are living longer, which is good news, but we're spending more of that time that we're living longer in retirement rather than in the workforce.
What kind of accounts or funds should a musician think about opening?
Yeah, so you mentioned the fact that if you're a musician, you're a singer, your income stream is highly uneven. It's a feast or famine. My wife is a dancer, and she runs a business from home. And some years there are a lot of gigs for performance and performance opportunities, other years not. And so what I tell her and the way we think about it in our family is if the natural income that's coming in is highly uneven, we say like, how do I kind of make it more stable? So we try to kind of build like a 6-month cushion. So for the first 6 months, we just put the income in there and then take the average of it and say, okay, that's probably the income for going forward. And if lots of gigs keep coming in and that 6-month average keeps edging up, then they might either spend more or save more, etc. But we kind of take the average of the previous 6 months to get a sense for what is the stabilized level is going to be. So that's sort of even thinking about what is income, I think for someone who lives sort of in the gig economy, and by the way, more and more people are becoming part of the gig economy. Fewer and fewer people are having this traditional I'll begin with one employer when I'm 25 and I'll retire when I'm 65 and have 40 years with the same person. That's like gone. I don't think there are very few jobs left that way. More and more people are working for themselves, and more people are like having this kind of uneven, uncertain, unpredictable nature of their income coming in. So I'll answer your question, but before we get there, the first order of business is not saving for retirement. The first order of business is putting aside 6 months of income for the unforeseen. We're living through COVID-19, and this would have been a perfect time to be dipping into that reserve that you created for yourselves of 6 months of expenses. I know the government is helping out and all that, but even so, that is the best sort of like insurance we can provide ourselves, is to have 6 months of expenses saved and kept in like a very easy to access liquid place. So we don't want to be investing in like, 5-year CDs. We don't want to be investing this in even in the stock market, because this is precisely when the stock market takes a 30% dip. So I would say, yes, the returns might be low, but put it in some savings account, or you can invest it in some US Treasury bills or something that can be money market funds, things that can be easily converted into cash. So I think that's the first order of business even before you start saving for retirement. Let's say we do that. We have provided for 6 months of expenses, and that's our rainy fund day. Then thinking about saving for retirement, and particularly the profile that you gave me of someone who's a singer, there are like a few options. So I'm assuming that this person is self-employed. Okay, so if you're self-employed, your good options that you have are the SEP IRA and the solo 401k plan. The SEP IRA is probably cheaper and easier to open. You can just call like Fidelity or Vanguard and open one. And you can do it even after the year has ended. So let's say for 2019, the year has ended, but we have not filed our tax returns now because it's extended to July 15th. Now is the time many people are thinking about, hey, what account should I open? You can still open a SEP IRA account and make a contribution for 2019, even though we are into 2020. It's just that we haven't filed the tax return for 2019, and so we have till then. So that's a good reason to open a SEP IRA. The solo 401k plan, on the other hand, is something you need to be more thoughtful and more deliberate about. So you need to open that before the tax year ends. So if you have, like you're in October and you say, hey, this year has been a pretty good year, I've made a lot of income, now would be a good time to start saving, I would then recommend that you open your solo 401k before the year end. The solo 401k, you can open a solo 401k plan only if you don't have employees. If you have employees, then don't open the solo 401k plan. Go to the SEP IRA or some other route. Maybe your bank can open it for you. So you should just call your bank, local bank, and say, hey, will you open a solo 401k? The solo 401k has got two parts. One is the employer piece and then the employee piece. Because you're self-employed, you can think of the total amount. I don't know what the specific amount this year is. It's probably like $56,000 or something. So it's a pretty generous cap up to which you can save. And if you're saving $56,000 a year, you're in pretty good shape, and if you're starting young in particular. There are some catch-up provisions. If you're like me, you're more than 50 years old, you're allowed to put aside even more money. Okay, so I think the tax code is written in a very generous way that you can contribute quite a significant amount of money if you're more than 50 years old. I think it's like more than $60,000, maybe $62,000 per year. It's called the catch-up provision for people like me who might be starting late. So these are the two options. The simple IRA is another option. So these are the options. The other thing to keep in mind when you're setting up these plans is, particularly for the 401k plan, is do you want to contribute on a pre-tax basis or an after-tax basis? So how should you think about it? If you think that your tax rate in retirement, which is after you're 59 and a half years old, that's when you can take money out. And after 70 and a half or something, you're required to take some money out called required minimum distributions. If you think that you're going to be at a higher tax rate then compared to now, maybe you should pay the taxes now. But most people will prefer to pay the taxes later because they think when they're retired, their tax rates will actually come down. I dream of retiring in a place like state like Florida where there's no state taxes. Maybe that's why a lot of retired people go to Florida. So, if that's the case, you're going to put money on a pre-tax basis in a SEP IRA or a solo 401k. But for some reason, so let's say you're a student and for the next couple of years, that would be a good time to sort of put aside money on a after-tax basis. You might still continue to sing, but you expect your income to be low for the next couple of years, which puts you in a very low tax bracket. That would be a good time to do it in a ROTH 401k, which means contributing money on an after-tax basis. Rather than get into the details of each of these, I think the more important one is to just pick one plan and stick to it and just be very consistent about it. Rather than super optimize about this plan versus that plan. Pick one. I would say go with the solo 401k and just do it year after year. Consistency is more important than anything else.
So just to be clear, what is the defining factor of being self-employed?
It depends on whether they get in the tax form that they give you, whether they give you a W-2 or they give you a 1099. If they give you a 1099, then you're considered like self-employed. If they give you a W-2, then you're considered an employee.
Does it matter if you get some occasional W-2s if you want to start, say, a solo?
No, you can do both. You can have a regular job. So solo 401k plans are very good for that. You might have a regular job, and through your employer, you might be contributing to a 401k plan that your employer offers. And then you set up your own SEP IRA or your own solo 401k plan, and then you can contribute even more. So it depends on your income and your ability to save. Many people will say like, oh, $19,000 through my employer, that's how much I can, and that's how much I do plan to save, and that's it, I'm done. I'm not opening any solo 401k. I'm like, okay. But others are like, I get only 3 months of salary from my employer because it's a very seasonal gig, rest of the year on my own, in which case you can have one plan through your employer and then start your own plan for your other income, which is, either 1099 or, my wife offers dance lessons to students. So they come home and they learn from her and they pay us every month. So that's, it's not 1099, it's not W-2, it's just income that she reports because that's the check she's depositing into the bank account. And so that is also something, your profits that you can include for calculating how much you can contribute to a solo 401k plan or a SEP IRA plan.
So you talked about if in a temporary capacity you lose your ability to perform, what we can think about doing. But what if you lose your ability to perform in a more permanent way? Do you have any suggestions on what a singer could think about?
There are different kinds of insurance, right, for different kinds of contingencies. I'll come to disability insurance, which is what you're talking about, but there are other contingencies we should think about as well. For instance, if people have kids, okay, then all of a sudden life insurance becomes very important. Till people have kids, they might not think about life insurance. There's nobody that's financially dependent on them. But once they have kids, they have somebody that's financially dependent on them, and we have to pay for their, living expenses, education, things like that till they become adults, till they can fend for themselves. So I would say you should get term life insurance when you have a child, okay? Disability insurance is another contingency, and the life insurance you're providing for the contingency that you're not around, that you pass away when you have kids for whom you're financially responsible. Likewise, the contingency we're preparing for with disability insurance is we're not able to perform a job. And there is short-term disability insurance. I think it covers up to 180 days, and long-term disability insurance, which is beyond that. And key thing to watch out for in these policies is something called an own occupation clause. That is, if you're a singer, and let's say something happens to your voice, if you're not careful with the disability policy that you're taking, let's say you're not able to sing, but you're able to flip burgers at McDonald's, they'll say, hey, you can do that job, okay? And that may not pay you as much as what you might make as a singer, because that's what you trained for your whole life. And so it's very important to take a policy that says if you're not able to perform your own occupation, then they will pay you. And the fact that you can perform some other occupation is not relevant for the policy, okay? That's the kind of disability policy I would recommend that people get. If you have an employer, sometimes they will provide the disability insurance. If you're self-employed, then you have to go get this policy yourself.
So as a singer, oftentimes you have to work in many different countries, and I was just wondering if you could talk about some things we should think about as we start to declare taxes but are being paid in other countries.
Again, I'm going to make an assumption that you're a US citizen or a permanent resident. If you're a US citizen or a permanent resident of the US, your worldwide income is taxable in the US. Okay, so, and again, in going back to my family, my wife performs abroad, and if she gets paid there, you have to keep track of the checks or wire transfers coming into your bank account and report that in your Schedule C income. Some countries will report to the US government. They'll send the equivalent of a 1099 to the US government. I think like Denmark does that, but many countries don't. So come tax season, the onus is on you. So it's usually a good idea to have a separate business bank account rather than mix your business income with what you do with your personal checking account. In that way, if you have a business bank account, you can look for all the deposits that come into it and say, hey, what does this relate to? You know, if it's something you performed abroad, the wire transfer came in, you declare that as your income, make sure you deduct the wire transfer free as an expense, and depends on who's paying for the airfare. If you are paying for the airfare, keep track of your expenses, have your receipts for like 8 years afterwards, because you're going to claim it as a deduction. So documentation becomes important. And for every city that you visit, you can either provide actual receipts for your food expenses, things like that, or you can claim a per diem expense as a deduction in your tax returns. But you have to take the responsibility for keeping track of all this income from other countries, declaring it to the US government, and paying taxes. Now, if you're living abroad for more than 180 days a year, 182 days in a year or something like that, then it's a different story. Then you can say, I'll pay taxes in that country, and in the US, they'll give you, even then the US taxes your worldwide income for being a US citizen, but at least if they let you exclude a big chunk of your earned income that is earned outside the country. But if you're living in the US and just flying back and forth and singing in Germany and then coming back to the US and going and singing in Australia, then you just have to pay taxes in the US.
So I know a lot of people who use software like TurboTax, but I'm curious, when is a good time to think about getting a CPA?
A large answer, part of the answer depends on your comfort level and how painful it is to do your own taxes. But if you are indifferent, I would say err on the side of hiring a CPA, particularly if you have, you're a singer, you have your own business, you might be using your house as a home office. From there, you invoice your customers and you pay your business-related bills and keep your recordings. It might be a studio for you, all of that. So in that situation, hiring a CPA could actually be, you might come out ahead financially because A, it's faster, but they also know how to do certain things, like how to claim the depreciation on your house for the portion that you use as a home office. And they'll ask you questions like, did you attend some concerts? Usually, if you're an artist yourself, you're going to attend other people's concerts, but it doesn't occur to you you're doing it as a professional expense, right? And so if I attend a concert, it's not an expense, it's just my concert. consumption. But if my wife attends a concert, it's a professional expense for her because she's checking out competition or looking for ideas. It's a professional development for her. So these kinds of things are different, but depending on your profession, and a CPA can sort that out for you. So it's probably a good idea on balance to hire them. I'm an accounting professor, but I've been using CPAs for more than 25 years. And I'll tell you this, every single year, they more than made up their fees by telling me parts of the tax code that I wasn't aware of. So they've more than earned their keep in my mind.
So I want to talk about life projects like buying a house or starting a college fund. Is there something that we as freelancers with a regular pay can do to maximize our chance of getting access to credit?
When you go to a bank and ask for a loan, they're going to ask for your tax returns, okay? And they'll want to see like you have a steady income, which is going to be harder for a performing artist. So at the margin, if you can move things around, move your gigs around so that you can even it out over the last 3-4 years, that will look better. Your credit scores become important. So, paying off your credit card bills on time, never missing a payment, those things will help. And you want to establish that record for a few years before you buy a house. So make sure you have an excellent credit score. And the other thing I would say is start saving. Initially, if there is an employer match, so if you do have an employer and the employer is matching your contributions, you have to take that. That's the first thing. So there is should I save for retirement? Should I save for a house that I'm buying? Should I save for my kids' college? So there is the pecking order here is make sure you take the matching from your employer if you do have an employer. And usually employers will match up to 5-6% of your salary or something. So that's free money. So you don't want to give up on that. So take that first, okay? After you are done that matching maxed out the matching up to a point, reach that point, then it's truly up to you. Some people are very intent on buying the house. Others would rather save for retirement. And it's a personal call. Nobody can tell you this is the right answer, that's the wrong answer. There is no mathematical or tax efficient answer for that. It's your personal priority, whether it's buying the house or saving for retirement, which one is more important. Let's say you want to buy the house. Here's what I would recommend. Go live in the neighborhood, rent in the neighborhood where you think you might buy. So that way you get to know the neighborhood, okay? And then the 3 years that it takes or 4 years that it takes for you to build up your down payment, walk around, figure out the neighborhood, do I like this side? Do I like that side? There's a new apartment complex coming here. What does it look like? What will shopping look like? How close are these to kids' schools? Whole bunch of non-financial considerations are much more important than financial considerations, okay? And by the time you saved up enough money for a down payment, 10%, 20%, this is also the time to take help from parents, somebody else that might help you with the down payment. And then you go to the bank and you pre-qualify. And you go to the bank and say, hey, how much would I be eligible for? And they will commit to you. They'll say, you can borrow up to $500,000 because I've looked at your tax returns and based on sort of the income and they'll ask for your, they'll have your bank statements, their tax returns, they look at all of this and they'll say, here's how much we are comfortable lending if you're willing to put down 10% or 20%, whatever it is, okay? So before you even start looking at homes, you can start a conversation with the bank and be sure what you're eligible for. And you should shop around. It's not just, don't go to your first bank with whom you have a checking account. They may not be the cheapest rate. You can go online and see what is the comparable rate. There are mortgage brokers who do an excellent job finding a good rate. And they'll also give you ideas on, how to go, how to prepare your credit history, all of that. So you can get in touch with the mortgage broker early on and tell them, hey, 2 years from now, I think I might be buying a house. What do you think I should do? And they'll help you plan for that. Okay, once you've got this letter from the bank saying you're pre-qualified for a certain amount, that's when you go looking for a house. If you're pre-qualified for a loan of $500,000 and you think you can put the down payment of $100,000 for a $600,000 home, I'll say start looking at $500,000 homes. The $600,000 homes look much better than the $500,000 homes. It's always true. The more you pay, the better they look, right? But if you get used to the higher amount, you'll end up buying a house that you can't afford. So it's very important to get your taste function settled on a house that you can very comfortably afford rather than at the high end of what you can afford. Because even after you buy the house, I promise you, you're going to spend every weekend in Home Depot for the first year fixing up that house, because there are lots of, unless it's a brand new construction, there are lots of things that don't come up at inspection that you didn't think of, or even furnishing the house, etc. So it's I don't know if it's financial planning or not, but it's just being aware that all of us, once we've seen a fancy home at the higher end of our budget, it's very difficult for us to come down.
I'm also curious, is there any point where a singer should think about starting an LLC?
The basic question you're asking is, should I incorporate or not? If you incorporate, you get what is called limited liability. Okay. Now, this is less likely if you're a singer, but I'll give you an example. Let's say you offer voice lessons at home and you have students coming home and they slip and fall because your steps were icy. You have a lawsuit, right? So one way to handle that is to have what they call an umbrella insurance policy. But another way to handle that is to incorporate yourself into a limited liability corporation, LLC, or an C-CORP or an S-CORP. Most people will probably do an S-CORP. And the S-CORP is a tax election. It's a flow-through entity. It still will be, the income will be taxed in your hands, but you sort of will pay yourself some kind of salary kind of thing. And it's got some tax advantages to set it up as an S-CORP. I think in my experience, people need to have an income of at least $250,000, $300,000 before they go that route. Otherwise, just, unless it's a very, if you're offering lessons in like karate or something, which is like more prone to injury and you're worried about lawsuits. I don't know, I can't think of a very litigious career. But if you have a very career that's prone to litigation, then I would say, yeah, incorporate right away, even if your income is like $10,000. But otherwise, I haven't heard of too many singers getting sued for the harm that their music did. So it hasn't happened yet. So I might wait a little bit. It's really up to you to evaluate your risks of a lawsuit or things like that. But if you think you need the protection from your creditors, so you may be borrowing big sums of money, or let's say you're organizing concerts and you sell tickets and then suddenly COVID-19 happens and you have to refund all the tickets, but you incurred all these costs, then that you could have a big liability. That might be a situation where you say, no, I need to incorporate. I can't handle this liability. I don't want to be personally liable for all of this. So it depends on the nature of the work that you're doing. But for most people that are just, going and singing and coming back and getting paid for that gig, I don't know that you need to incorporate right away.
Professor Narayanan, thank you so much for being here today. I really appreciate you taking the time to talk to me. I'm Theodora, and we've been in the wings with Professor Narayanan. Join us next week as we talk with Russ Anderson about pro-filming versus self-filming. If you liked this video, please subscribe to my channel. And if you have questions you'd like me to ask in the future, please feel free to leave them in the comments below. I hope you can join us next time.